with our trading objectives. Actually, in order to meet or increase the odds of meeting our trading objectives, we better choose the right timeframes. Like, for example, if your goal was to catch long-term moves, okay? So let me move back to the S&P. So if your goal was to catch a long-term move, and this is a monthly time frame of the S&P. Okay, let me disable all the tools I got on the screen so we have a clean chart. Let me delete the drawings. Okay. So if I was to zoom out, okay, even though in the recent times the level of volatility that we have seen both to the downside and to the upside, it's fairly explosive. Just to stay in the politically correct use of my words, okay, it's been hot, okay, not a joke. So, but even though we got these, intense movements to the downside, this is not the first thing that this happened, okay, and then we have this very strong continuation to the upside as a very long-term uptrend on the S&P 500 index in this case. So let's say that your belief, your analysis, your trading methodology suggest that you should be a buyer to catch the move and continue the trend. And, let's say that you were to set your targets using, for example, Fibonacci projections, okay, where you've looked at this pivot low and you've seen this pivot high, and then you can see this particular retracement. And when you do an extension or projection, you can see the multiple Fibonacci lines. And let's say you expect the S&P to reach 7,000 before the end of the year, and you want to catch this long-term move where you expect the S&P to go from 5,464, which is current price, all the way to 7,000. So it may take a whole year for this to happen. And let's say that's the move you expect to catch. This is your trading style, and this is what your analysis suggests. Well, you may be wrong. Yeah, sorry, you may be right. I meant to say, and this could be a beautiful trade to be executed. The problem would be that your analysis here done on the monthly time frame that sets your expectation to reach 7,000. Let's say that you were planning your entries using a 1 minute time frame. Okay, let's say that was the case. You are analyzing the markets on the 1 minute time frame, trying to identify where is the right place for me to enter, and from there try to catch the move all the way to 7,000. Well, I guess that we probably all agree that from a common sense point of view, looking at a 1 minute time frame when your analysis was done on the monthly time frame, right, is basically looking at noise. That's basically what you're analyzing. You're trying to plan on an entry based on noise. So why am I calling it noise? Well, because if a market, let's say, for example, stocks, if a market trades 6.5 hours a day, and every hour is 60 minutes, so that's 390 minutes per day, and we have 252 trading days in a year, right? So you know what? Let's call it per month. We have 21 trading days in a month. So basically, you in a month time, which is only one candle on that monthly time frame, you actually have 8,000 over 1 minute candles. So I mean, going from zooming out so much to next thing you know, zooming in that much, it's basically you are analyzing noise. And I'm not saying this is not relevant, but it's only relevant if your goal was to do kind of like catch an intraday trade and just, just catch, 10, 20, 50 points. Great, fantastic, actually beautiful trade. But if you plan to catch 1,500 points out of looking at a 1 minute time frame, so again, I guess that maybe this analysis is coming from an angle where maybe, we happen to have a very perfectionist mindset, and we are trying to analyze everything. And we went from monthly time frame all the way to the 1 minute time frame, but it actually makes no sense, right? So we need to align the time frames with our objectives. If your objective is an intraday objective where you plan to capture quick price fluctuations, and you plan to have many entries to the long side, to the short side, frequent entries and exits, so then maybe the 1 minute time frame is your time frames. Maybe the 5 minute time frame if you want to keep it a bit cooler. Maybe the 15 minute time frame if you are a relaxed guy, but definitely not the monthly time frame, and vice versa. If you are planning on a position trade where you plan to ride broader moves maybe you are even deciding to get into this trade because of fundamentals, which is a powerful thing to do, but very difficult to be used for timing purposes, right? Because I mean, like fundamentals, the unemployment number comes with one month's delay. The earnings reports of the company come with 3 months delay. So in other words, while it's important data, there is a challenge to time the markets with precision, with fundamentals, isn't it? Again, I guess I make sense from a common sense angle again, right? So in other words, nothing wrong with putting yourself in line with the fundamentals. It's a powerful thing to do, but if you were to plan your trades on the 1 minute time frame, again, you will be in trouble, right? So again, very, very important to be strategic at the selection of time frames instead of just pick a time frame just because you didn't think about it or just because you saw it in that book, okay? So what are some of the selection factors? Okay, one is volatility. If you are a person who appreciates volatility, if you like speed, you want to be in and out quickly, you are not a patient person, then lower timeframes probably is the way to go. Even though in the recent times, especially a week and a half ago or so, we saw a 10+% move to the upside on the S&P 500 index, which is the largest equity index in the world, and it moved over 10% up in one day. So that is, I want to use the word crazy, if you guys allow me to be informal for a moment. Beautiful to watch, but definitely way beyond what expectations could be. It almost never happened like that, okay? So in other words, if you are shooting for volatility, trying to catch those crazy moves, I say it again, in a time frame such as daily, it's probably not going to happen fast or often. Often. I didn't mean to say fast. Whereas if you wanted to catch some volatility and you were to plan to do this intraday, well, actually, you have many possibilities. For example, you can just tune in the S&P 500 every Thursday at 8:30 a.m. New York time, where unemployment claims will be reported, and those particular set of news, for example, they will create volatility that typically is seen at an intraday level. It may not create a new trend in the weekly time frame and the monthly time frame. The fact that the unemployment number for the week was reported, it may not create a new trend overall, but it may create a spike of volatility intraday, just like other reports, could be GDP, retail sales, inflation data, FOMC meetings, et cetera, right? So in other words, if you want to shoot for volatility, lower timeframes could be a good ally, so you can find opportunities in a regular basis instead of only when something, pretty unexpected happen in the market, like it's been happening in the past weeks, right? Liquidity. Well, more liquid markets allow for better execution at any time frame. So liquidity, to be honest, it helps everything. It helps the long-term traders, and it also helps the short-term traders. Now, if you need to trade a market which is illiquid just because you choose to, maybe you have reasons to do that, maybe because that company pays amazing dividends, so you want that, but getting it and getting out gives you slippage, but you still choose to do it, then you can do it because liquidity helps everything. So it allows you to use whichever time frame you'd like, including if you are at a little bit of a disadvantage. Okay, personal availability, right? So when are you able to trade? When are you able to be in front of your computer? And do you need to be in front of your screen when you trade? Is that part of your trading style? Do you need to watch your trades? Do you need to move your stops? Or are you a set and forget type of trader that plans the trades, the day before and you execute the day after, or during the weekend and you execute during the weekdays? What type of trader are you? What's your personal availability? This would set the use of the time frames. Risk appetite. In a moment, I will demonstrate how different time frames have different level of risk. So depending on your risk appetite, you may be forced by your trading psychology to use a specific set of time frames. And then the tools that you use, right? Maybe you are utilizing order flow type of tools that give you access to book data, and that is very useful to your trading methodology, but which, by the way, that type of tools are basically only useful for very, very short-term trading all the way to high-frequency trading. So if you are using certain tools or techniques, then you may be forced into these very, very short-term timeframes, or maybe not. If you are not using other tools, or you're using other tools that are, more flexible or advanced, maybe you can use other timeframes as well. Okay, so again, so far as we started the session today, I spent tons of time throwing kind of generic concepts which are important to build kind of like a base for our conversation. I plan to speed up our conversation now and jump into the real-time charts to do some demonstration in just a moment. Okay, so bear with me on that. I had to phrase all of this just to make sure we are in the same page. So multi-time frame analysis is the process by which a trader may use multiple timeframes to confirm if a trading setup is valid or not, because by looking at multiple timeframes, we may be able to avoid false signals or noise, which could lead to low probability trades. So again, I'm going to do this live in a moment. And typically, when using those multiple timeframes, a top-down approach is what most traders would implement. So you will start from a larger time frame. Let's say you are using the weekly time frame. So you start from the weekly, and then you go down to the daily, and maybe you even go down to the hourly time frame to have a reconfirmation or a confirmation for an entry or something like that. Again, I'm going to do this with real-time charts in a moment. The slides with this information here is just for if you were to download the handout and you are just reviewing what you learned today. So at least you have it written somewhere, okay? But I will do this live. So let's do it. Let's go live. I'm going to use TradingView in this first practical application. I'm going to start with a daily time frame, and since I talked about future, let's move to stocks. I'm going to use McDonald's, for example, as a stock. Okay, and the first thing I would like to do here when looking at McDonald's is I would like to reactivate on the bottom part of my screen a tool that we call Auto Climate, which, by the way, one of the free resources I'm going to share later is that I will show you how you can get access to this tool for free, forever, for life, for everyone, okay, attending this live or recorded. So later you just need to follow the instructions and you'll be able to get this tool. And by the way, you don't have to use this tool. You may have other methods that you prefer. I will show you different ways on how to do certain things. I'll start with this particular tool. So this particular tool on the daily time frame, by the way, I'm going to start with the weekly time frame. With this particular tool on the weekly time frame, this particular tool is showing me blue color. Okay. What does that mean? That means that we are in an up climate. This is what it means. We're in an up climate. Another way to say that using technical analysis terminology is that you may call it a trend, an uptrend, even though I prefer to use the term climate for a collection of reasons that I have explained in other recorded videos with interactive brokers. Feel free to go on and check those. Basically, the climate has a lot to do with not only the direction of the movement, but also the sustainability. Are you late to the party? Is the trend going to change direction, or is it likely going to sustain? That kind of thing. Today, to keep it simple, I'll just focus on the color. And because it's blue, in my mind, I am thinking, I want to be a buyer of McDonald's. So let's say that you have done your analysis on the weekly time frame. Why weekly? In this first example, I am wearing the hat of a position trader. So I'm using large timeframes to do my analysis. And I just concluded that I want to be a buyer of McDonald's if I was to do the analysis the way I'm doing, right? So now what? Well, some traders may just go ahead and buy, okay? But again, we just talked about the use of multi-time frame analysis. So in this case, I'm going to move to another time frame to confirm if this is a false signal or a noisy type of market data. So what am I going to do? I'm going to go from the weekly time frame to the daily time frame. And when looking at the daily time frame, I can see I also have a blue dot. So in other words, I get something that we could call confirmation or extra evidence. You could use whichever word you like best, that resonates with you best. But basically, we can see that two different timeframes are basically giving us the same statistical indication when it comes to what this market is likely going to do, which is to keep moving higher. okay, based on this particular analysis. Now, instead of autoclimate, maybe, so let's forget about autoclimate for a moment. So maybe what you do is that, you use a collection of moving averages. So you use a moving averages ribbon, and in this case, you can see on the daily time frame, all the lines are pointing up, okay? And when you look at the weekly time frame, all the lines are pointing up. So maybe this is your way to do these assessments. Maybe you are using technical analysis techniques such as drawing trend lines and things like that. Again, I just want to show you that what I'm doing is quite universal, even though I'm using a tool called AutoClimate to save myself time and overthinking and emotional traps. I'm just following what technology says because computers do certain things better than humans, okay? So weekly time frame is blue, daily time frame is blue. What about the 4-hour time frame? It's blue. So I am using 3 time frames where all of them confirmed that being a buyer makes statistical sense. Okay, so right now it's time for me to plan on the trade. Okay, now what should I do? Should I keep going down the time frames and down the time frames and down the time frame and keep doing that all the way to the 1 minute time frame? No, because now I would be analyzing noise. I already got 3 confirmations. I think that that's perfectionist enough. Typically, traders around the world, they use 2 or 3 time frames to do their analysis. Could you use more? Yes. Is it probably going to be redundant or overcomplicating? Probably yes. So 2 to 3 seems to be an kind of like unwritten rule in the industry. When I talk to many of my trader friends or other professionals in the industry, that's what we all do, 2 to 3 timeframes to do our analysis. Okay, so here we go. You could certainly backtest any other approach, but this is, basically what I'm sharing with you. So what's next? Okay, well, the next thing to do now would be to plan on the entry. Now that I know what direction in which I want to trade, so now I want to plan on my entry. And when planning on an entry, at least the way I think about trading, to me, it's all about, I'm not even thinking of an entry unless I got room to make a nice profit. So the first thing I do is I think of my exits before I think of my entries. So in this case, I'm back to the weekly time frame because this is the type of trade I'm planning to catch is a position trade. So I'm back to my original time frame after I got a confirmation that the weekly time frame showed me what I wanted. And I'm going to do the same thing. I'm going to do a Fibonacci extension. I know there are many ways on how to set targets, but if that's okay with you all, I'll use the same technique as before. And here, what we are doing is that I am planning to catch a move to ride McDonald's all the way to 341. So that would be my goal, to catch a move with McDonald's all the way until McDonald's reaches the target 341.88. So I'm writing it down here. So this is serving me as a cheat sheet, as you will see in a moment. Okay, so this is where I want to go with McDonald's, 341.88. Okay, now for me to do this, I need to find my entries. So I looked at the weekly, the daily, and the 4-hour to confirm the direction of the move. Okay, so now let's go ahead and look at the 1-hour time frame to identify potential entries for this potential trade. Okay, so now what do we have? Well, notice that I have buy on field orders available here. To be honest, it's funny because when I was looking at the market right before the session started, the market was here, and there was a green UFO right there at 317. As the market has been trading now for an hour, so you can see how McDonald's went into this green UFO right there and then started moving higher. So actually the trade that I had in my mind is already happening, so I am late to enter. But it's okay. If I miss this one, there is another green UFO below at 307. So 307.28 would be likely a nice place for my entry. So 307.28 could be a good price for my entry. Okay, I'm using here auto UFOs, which is technology that I have developed. Again, many other ways on how to set your entries. I'm going to go back to the weekly time frame again, just to give you more alternatives for people that are not using this type of technology. So instead of Fibonacci extensions, we're going to use retracement. So if I go from top to bottom, okay, so there is a green line there at 308, and the bottom line is 304. So anywhere between 308 to 304, that could be a valid entry if you are a Fibonacci trader. So look, I'm going to place my stop at 304, okay, in case I'm wrong, okay? So now if I was to do this trade, okay, what do we have? So this trade would be a trade. Let me try to make it more understandable on the screen. So 50%. Okay, so we have 61.8. We have this. Okay. Oh, wait a moment. I just clicked on the wrong tool. Here we go. I'm going to go for one. Okay, great. Sorry about that. I just clicked on the wrong tool. And then here we're going to leave 50 and 38. I'm just leaving the colors that are relevant, okay? Here we go. So now this is going to be more understood, okay? So the goal here is if McDonald's come down to this green zone, I'm going to buy. And if it keeps rallying all the way to 341, I'm going to exit, okay? And if I'm wrong, I'm going to lose that amount. And if I'm right, I'm going to make this amount. And this is going to take a while for this to happen, which is a position trade. I'm doing a midterm to long-term type of trade, right? So what is my risk in this trade? Well, I'm risking $32.80. If I buy 100 shares, I am risking $300. And if I get to my target, I'm going to make $3,000 over dollars. This is a 10-to-1 trade. I am risking 10 times less than what I would make, which is very adequate for a long-term trade because a long-term trade has exposure to gap risk, and we don't want to be, naked in front of possible gaps. So one way I offset my problems here is by having a very decent reward to risk ratio, 10-to-1. So if I get stopped out, I lost very little compared to what I would have made. Okay. So anyway, so this is the trade, and again, this is not trade advice or anything like that. This is just for demonstration purposes to demonstrate on how, by using the mindset of the time frames that was in line with my position trading style, I went from the weekly to the daily to the 4-hour to have a confirmation of the direction and then picked an entry. Okay. Now I wanted to also demonstrate that the lower the time frame, the lesser the risk. So notice, with 100 shares, my risk out of a weekly time frame trade is $328. So let's cancel this trade, and let's erase everything on the screen, and let's start again. And now let's change hat, and let's pretend that instead of a position trader, I am an intraday trader who wants to plan a trade using the 1-hour time frame, 30 minutes, and 15 minutes. Okay, so let's do the moving average technique now instead of the auto climate, even though all of you will have the tools, this tool available later. So in the 1-hour time frame, this market is going up. In the 30-minute time frame, this market is also going up. In the 15-minute time frame, this market is also going up. So you may conclude, I'm ready to go. I want to be a buyer of McDonald's, but in this case, it's going to be for an intraday trade. Okay, for an intraday trade. So what could you do? Well, you could do the same thing. Okay, I'm just going to replicate what I did before. So this is the beginning of the move. This is the end of the move. This is the retracement. And that brings potential targets to be here and here and here. Okay, those are my potential targets. Okay, so let's say you are shooting for McDonald's to reach 323 before the end of the day. So big breakout, keep going all the way to 323, and you plan to catch this move intraday. So now that you have identified that, okay, again, maybe what you do is that you go to a lower time frame, like I've done before, 5 minutes, to try to find your entry. In this case, the entries are so much lower, so it's not ideal. So if that's okay, I will not be too confident this trade is a very good one. But just for the sake of this practice, I'm going to do the same thing I did earlier, which is I'm going to use fibber retracements, and I'm going to go from top to bottom. Okay, and I'm going to use this green zone as well as my entry. Okay, so if that was the case, let's take a look at the risk impact. So 323, 28, that was my target. My entry would be, let me make it larger so everybody can see that better. Oh, that was unfortunate. I just moved the Fibonacci lines instead of, okay, good enough. Instead of moving the chart. So I wanted to do this. Here we go. So 317.40, that would be the entry, and 316.78, that would be the stop. So if I do that, 317.40 and the stop 316.78, when we do that, well, notice that now with the same 100 shares, my risk is no longer 328, my risk is now $62. And we are talking about the same stock. So it's not like I changed to another stock, which is lower price point or anything like that. I'm talking about given a specific market, when you go down the time frames, you reduce the risk. Okay? So the risk in dollars, okay? The risk in dollars, okay? Because of course, if I add more shares, then of course I have more risk, okay? But the risk in dollars, given the same amount of shares, is less just because I went to a lower time frame. So, in other words, going back to the slides, it's very important that we define this properly, because many people trade whichever set of time frames just because instead of having a strategic decision about the usage of timeframes, either based on the trading style, as I kind of demonstrated with the weekly, daily, 4-hour trade at the beginning, or with the intraday trading style with 1 hour, 30 minutes, 15-minute time frame that I have demonstrated afterwards. Okay. So risk implication, trading style implications, time availability implications, money implications because it's risk and so on. Choosing the time frames is not something that you want to do blindly. It's something that you have to do strategically, methodically, because of all the reasons that we've discussed. You want to put your decisions about the time frames that you trade in the context of your trading plan. So define your style, and that will define your timeframes. It's very important that you have a trading plan. It's very important that you have a defined trading style. It's okay for you to have different styles of trading, but for that, you need different trading plans that will use different time frames. It's a typical mistake that some traders keep switching time frames until they see something that like on the screen, which may be totally psychologically biased just because you are coming from 3 wins in a row or 3 losses in a row, and you keep switching timeframes until you see something that for whatever reason triggers a good feeling in your mindset, which is obviously a very subjective way on how to trade. Okay, so risk by time frame, I think I made my point, is absolutely critical. You have smaller stops intraday, wider stops when you trade position trades. So there is an implication of risk, and it's definitely very important that you have a careful decision there. And consistency, as I said, be deliberate. Always use the same time frames combinations. Don't improvise. Okay, don't avoid the temptation to jump from time frame to time frame in the middle of a trade as you are planning on a trade, or in the middle of a trade management approach that you may have. Maybe you move your stop just because you switch time frame, just because you felt like that today, and it's totally subjective. You want consistency. Consistency compounds. Strategy drift does not. Okay, so make sure to be disciplined. So we're gonna break in just a second for questions and answers. I wanted to flash on the screen the additional resources I mentioned. I am very happy to share with everybody. Notice that, of course, you can download the slides. You can take a picture of these or a screenshot of what you have on the screen right now. You can scan the QR codes. You can make a note of the URLs. I guess, depending on your preference, everybody got a solution. But basically, you have 2 choices here. One is to go take a look at our YouTube channel. There are over 1,500 videos, including live trading, including lessons on time frames and more. So feel free to enjoy yeah, just enjoy and learn. Basically, tons of materials. And then talking about tools, maybe you liked, even though I used it very briefly, but maybe you liked the simplicity and the power of AutoClimate. So if you want to use it in TradingView, you can just click on this link or use the QR code. It will bring you to our website. Just follow the steps. It will not require any credit card or anything. It's free. Just follow the steps. You will input your data, your email, and so on, so we can send you activation links, and our activation team will take care of you, and you'll have AutoClimate in TradingView forever, and enjoy it. So before we get into the Q&A, last slide. Takeaways. Timeframes define your trading personality. Higher timeframes give you more of the context. I was using it to pick the direction of the trade, where lower timeframes give you more the precision. I was using it to define entries and exits with precision. So I got to this 10-to-1 reward to risk ratio, right? Precision pays. Combining both improves consistency, clarity, and confidence. And additionally, tools like AutoUFO's AutoClimate could add structure and objectivity. Not for everybody, but it could. And very important, practice, calibrate, and refine. Trading is a craft. Do not improvise. Put together a trading plan where you decided on which timeframes to use strategically. Take those trades and repeat. Okay, that's the approach. Okay, like an industrial process. Okay, so we can create quality. Anyway, so more than happy to take any question. If any, I would assume there are questions. I am ready for those questions, Andrew.
Jose, very, very nice. Some positive comments there from the audience, saying thank you very much. It was very clear. Ian asks, how do we get access to AutoUFO?
When you use our QR code here to get AutoClimate for free, it will bring you to our webpage. And after you complete your AutoClimate registration, you can click on a button which is Apps. And the moment you click on that button, you will be able to see the various choices for AutoUFOs. Okay. Yeah.
Okay. And Che asks, can you share the links? Che, and to the rest of the audience, if you go into the handouts section of the GoToWebinar panel, you can download the presentation and you'll be able to access from there. That will also be available on the Interactive Brokers website later today. Robert asked a question about 10 minutes in, Jose. What about setting up a webhook from TradingView?
Right now, unfortunately, it would take a bit too much time for me to demonstrate that, but it is indeed possible to set up a webhook. So you can connect other sources that you may be utilizing, such as your interactive broker platform, or maybe you have access to other data sources that you use in your analysis. Maybe you download I don't know, fundamental data from Yahoo Finance, just to pick a generic website, and you want to connect that to your TradingView, so you can set up webhooks and make your life a bit simpler. If that's okay, I will take this suggestion as a great idea for a webinar sometime in the future. I'll make a note of this, and I'll be happy to prepare a lesson on that.
I say Bernard asks, he notes that he trades options as a swing trader. So when thinking about timeframes, he also thinks about options durations. Do you have any comments on selecting durations for options when you're doing this kind of analysis in terms of timeframes? And do you have lessons on your YouTube channel discussing this? Yes, there are lessons in the YouTube channel discussing this, since I can do that very quickly. So I'll just, I'm still sharing my screen, I believe, isn't it? So yes. I'll do something very quickly here. So earlier with McDonald's, if I'm not mistaken, we were planning on a target. I think it was around 341 or something like that. So let's pretend our target is this blue line, okay? And you are right now in the present ready to plan on a trade. You are ready to plan on a trade out of the weekly time frame.
You are ready to plan on a trade to potentially catch this target at 341, right? So what expiration date should you use? Which it's not a time frame, but it's definitely very much related. So I'm very happy to hear the question. So what I like to do very much, okay, so you remove all subjectivity, is to use a regression channel, okay? And just pick a very relevant turning point, such as this one. Okay, a very relevant turning point basically is setting the behavior of the current trend. So I would draw a regression line from that beginning to the current price, and basically this draws a regression channel that shows me when that blue line could be hit. And the moment you know when that blue line could be hit, using the middle part of the channel, you can now look at a horizontal line and you can look at the dates and notice that November could be that date where finally you reach your target. In other words, if you were to use options and you want to know which expiration to use, you want to make sure that it's at least November, so your options don't expire sooner than you reach your target.
Very good. That's very interesting. Hope that answers the question, Bernard. That's all the questions. Thank you very much, Jose. Very informative. I always appreciate when you hop on and do a webinar with us.
It's always a pleasure, Andrew. Thank you for having me. Thank you, everybody, for attending. And I am around the corner. If anyone has any additional question watching this recorded, I could be reached via email, and happy to help. Thank you so much.
Brilliant. Thank you to the audience too for your time today. I appreciate it very much, Jose. Thanks, and bye for now.
See you soon, everyone. Bye-bye.